History tells us that what exists today may not exist tomorrow. And I don't know about you, but I'm in New York and we are in the midst of a polar vortex. I'm not loving the weather. In many ways, the market is like the weather. If you don't like the current conditions, all you have to do is wait a while. So I am waiting for springtime and hoping that it comes soon as it relates to the weather. Now, the weather and the markets have been favorable, but this is a good reminder for the future. Lessons over 100 years of investing, and I'm going to give you some examples for each of these 5 mantras. The first is that fundamentals matter. The second is that time is an investor's greatest asset. The third is that diversification does work. The fourth is that we need to balance opportunity with risk. And then the fifth, as I alluded to earlier, is that disruption is constant. Over time, stock returns are not going to be positive unless there's earnings. Now, it may not move in parallel with one another, but what we know as we look over the last 30 years is that over 3/4 of the stock returns that we've experienced has been driven by earnings. The other thing we know is that positive earners have significantly outperformed those companies that have negative earnings. So I've heard people talk about the stock market as a gamble. It feels like you're going to Las Vegas. You don't know if it's going to go up or down. And in any given day, maybe. But ultimately, there are fundamentals that matter, and it's the health of the company that you're investing in. Ultimately, think about stocks as ownership. You are a part owner in a company. You want strong free cash flow. You want to see sales growth. You want to see earnings growth, and you want to see low debt. Those, quite frankly, are 4 things that you want to see in your personal net worth situation as well. When we look over time, stocks have averaged just over 10%. I think it's important, however, to remind ourselves that 1 in 4 calendar years has been negative. So if you think about 75% of the time, your calendar year is positive, 25% it is negative. And I mentioned before, in 6 of the last 7 years, we've actually seen double-digit return in the S&P 500 index. So if we were to see, I don't know if it's going to be 2026, 2027, we would expect at some point we're going to see a negative rate of return in the market. Another observation here is that as you start to introduce additional asset classes, the likelihood of a negative year does in fact go down. So time is an investor's greatest asset. We like to say that it's time in the market, not timing the market that matters. You've heard us talk about this in the past, our current clients, but it's worth repeating because in an environment where we're saying that valuations are expensive, you may be thinking, well, maybe I should just get out of stock. Well, the problem with that approach is that you need to get 2 decisions right: when to get out of the stock market and when to get back in, which is why we are not proponents of timing the market. The reason why missing 10 of the best days has such a negative impact on your success is because the best days tend to happen in and around the worst days. So it's nearly impossible, we don't have a crystal ball, to identify when those best days will be. This is why when we think about building portfolios, diversification is something that matters. Rebalancing, we're going to talk about in a minute. That is our equivalent of reacting to the markets. I love this slide. It demonstrates calendar year returns for a 60/40 portfolio. Back in 2022, when bonds had their worst year in decades, there were multiple headlines that talked about how maybe the 60/40 portfolio is dead. And what that means is a balanced portfolio. And at that time, it seemed like the reality. But again, when we zoom out, there's years where that doesn't work. You can actually see 2022 happens to be one of 3 years where your rate of return for a 60/40 portfolio was between -20% and 0%. But the lion's share of the time, it's been positive. In an environment where you hear a lot of investors talking to their individual stocks and what's driving performance. I always get nervous for especially our young investors who might have had some early success investing in individual stocks. They don't appreciate how significant luck might happen when it comes to the amount of time and when you get into the market. This is a great lesson in math, but it's something that is just so important to stick with you. The mantra of doing no harm, managing losses matter. And why is that the case? Well, big losses are hard to recover from. In fact, if you had a 50% decline in a stock, you would need a 100% gain to recover from that loss. So that's pretty staggering and perhaps overwhelming. The good news is that if you were able to limit your loss, the gain you would need to recover is a lot more manageable. A 25% loss, you only need a 33% gain. And if I'm looking at your portfolio overall, a balanced portfolio, you see a 10% loss, you actually only need an 11% gain to overcome that loss. So math matters, managing losses matter, and this is why we belabor the point of diversification. And how do we manage that diversification? We manage it through our rebalancing process. The graph here shows us a portfolio that was a 60-40 in 2019. In the absence of rebalancing, would have grown to 72% stock in 2025. Now, rebalancing can occur based on market movement, but don't forget, we're living off of our portfolios. We also rebalance based on cash needs. As you need to take liquidity from the portfolio, or as an investor is adding liquidity to the portfolio, we're going to draw from those sectors. We're going to take from the sectors that are overweight to our target, and we're going to add to the sectors that are underweight to our target. The fourth of the 5 mantras is that we want to balance risk with opportunity. And I can't emphasize enough the importance of your spending rate. You know, we spend a lot of time doing sophisticated planning and modeling, and it leads to some great conversation about the trade-offs, right? You know, what happens if I spend more? What does that do to my legacy? Or if I take more risk or less risk, what does that mean to my retirement age? But I do believe that there is something to kind of these rules of thumb, the back of the envelope math. And ultimately, your spending rate, your withdrawal rate is going to be driven by, one, the way you're investing, but the size of your portfolio. And over time, we really don't want to be spending much more than really no more than 5% of the portfolio. I'd guide you more towards 4%. So if you think about your spending as the liability your portfolio needs to meet, and we think about the potential return as the growth mechanism, as long as we're able to thoughtfully manage your cash flows during periods of volatility, then we're just relying upon your portfolio over a market cycle to outperform this spending rate. Think about that. If you're spending 4% of your portfolio if you're looking to maintain the purchasing power, you need to outperform that. But where investors get tripped up is not bucketing and not thinking about their short-term cash needs and when to get it. Lastly, I mentioned in my opening remarks disruption and innovation and how they are a constant. It is understandable to think about this as a relatively new phenomenon, right? I mean, artificial intelligence was not dominating the mainstream headlines a few years ago. I think this is a great reminder that every generation has its disruptive technologies. What we see here is that the amount of time it took for 25% of the US population to be using this new technology in earnest. So it took 48 years for more than 20% of the US population to be using electricity. Fast forward, it took less than 5 years for social media to reach 25% of the population. Artificial intelligence, even more, 2 years. So the transformative, disruptive nature of innovation is not new. And what we know is that the incumbents that exist in the beginning will be challenged. New companies and industries are going to come on board. And there may be a paradigm shift within each of these innovations. You think about RCA radio or Magnavox television set. They were leaders at the outset, and it transformed over time. We mention this because big tech companies earlier, while they might benefit from AI, it's not just the companies providing the microchips that matter. It's to think about how are companies going to use this to become more efficient. Ultimately, maybe driving the cost down of their services or expanding what we can do in a shorter period of time. What does this mean to you? We want to beware of the hype. Take advantage of opportunities from disruption means that we're not making bets, that we are making sound investments based on what is occurring in your personal situation.